Hello, and you're welcome to this special edition of Global Business Insights, where we are looking at the conclusion of the first Monetary Policy Committee meeting of the Nigerian Central Bank, the first meeting under Mr. Yemi Cardoso. And as we expected, a decision was taken to tighten further, and that was to address the rising inflation, raise real interest rates, and encourage inflow of capital to support the naira. The result, which is going to be high cost of capital and borrowing, will weigh on growth and hurt investors' returns, even as the central bank is projecting 3.38% GDP growth in 2024, lower than the federal government projection of 3.88%, but higher than the IMF's 3%. The governor announced interest rates was hiked up 400 basis points to 22.75% from 18.75%, reducing the negative interest rate from minus 11.15 to minus 7.15. Many analysts had expected a hike as much as this, some even more. Cash reserve ratio is now up from 32.55 to 45%. That is quite a hike, which was somewhat unexpected. A tough move, which many say is to curtail money supply, which is really becoming a tough cookie to address. Liquidity ratio was maintained, and the rather hawkish posture is to get inflation down before tackling growth. Money supply may have needed a shock treatment, and it may have got one in the cash reserve ratio elevation to 45%. Tilewa Adibajo is also here with us to give his own comments on how he saw the meeting.
The Central Bank of Nigeria, in the statement by the governor after the MPC meeting, Dr. Yemi Cardoso, increased the MPR by 400 basis points from 18.75% to 22.75%. It also saw an increase in the CRR from 32.5% to 45%, and the liquidity ratio remained at 30%. This is a bold move to signal significant tightening. This, of course, is important because money supply has jumped up by 40 trillion between January 2023 and January 2024, from 53 trillion naira to standing now at 93 trillion naira. This tightening is becoming effective because the governor has set inflation targeting at 21% for year end. In order to meet this tightening is also very important. And the governor has, in the same vein, announced that the next Monetary Policy Committee meeting will be taking place in the next 4 weeks. So are we to expect more tightening at that point in time? What is very interesting also is that the central bank governor talked about the problems of the foreign exchange market and blamed speculators, because Binance, a cryptocurrency operator, has done close to $20 billion worth of transactions in Nigeria just in the last year alone. So there are lots of issues outside the real market putting pressures on the Naira exchange. But overall, I think this monetary policy signals the tightening that is required to bring down inflation and take Nigeria from a point of stagflation into the path of growth. So we'll begin to see the markets react in the next 2 weeks as the rates are transmitted in the system, and we can begin to look at more open market operations as the central banks begin to further tighten the markets in an era to reduce liquidity and to restore balance in the foreign exchange markets.
Monetary factors driving inflation, such as persisting insecurity and infrastructural deficits, and noted the role of fiscal policy in addressing these shortfalls, while reiterating the commitment of monetary policy support. In this regard, the committee applauded fiscal policy initiatives towards reducing the cost of living for ordinary Nigerians, including the ongoing efforts to improve food supply and provide mass transit CNG buses to ease the cost of transportation, and the civil service reforms to improve the efficiency of government, amongst others. Key developments in the domestic and global economies. Headline inflation year on year rose to 29.90% in January 2024 from 28.92% in December 2023. Food inflation increased to 35.41% from 33.93%, while core inflation rose to 23.59% from 23.07%. The major factors driving inflationary pressure remain exchange rate pass-through, rising costs of energy, high fiscal deficits, and lingering security challenges in major food-producing areas. In addition, global factors such as tight financial conditions and trade disruptions from ongoing geopolitical tensions remain significant upside risks to the outlook for domestic inflation. Staff forecasts, therefore, indicate that inflation will remain on an upward trajectory in the near term before commencing a descent. Real GDP growth improved in fourth quarter 2023 to 3.46% compared with 2.54% in the previous quarter, driven by improvements in both the oil and non-oil sectors. The recent improvement in the oil sector was due to the combined impact of increase in crude oil production and a relatively high price in fourth quarter 2023.
The governor said Nigeria does not have wiggle room for failed interventions or wrong policies. Thankfully, the banking system remains stable, and hopefully, if we continue to get monetary discipline, not frustrated by fiscal excess, we should see the macroeconomics improve. Reserves were also said to be stable, actually went up to $35.5 billion as at last week, compared to $32 billion at the end of last month. Thanks to the reforms we've seen, especially foreign exchange and plugging leakages and better returns from oil exports with firmer prices, at least in the last quarter of the year. The statement was short, much more traditional. I thought we would get something on 2025 projections to give an idea of the trajectory to over 6% GDP growth promised by government. The MPC and the CBN seem to be saying, as they've always been saying, let's deal with the short-term issues first, get through 2024 and succeed in managing the difficult trade-offs and getting higher growth while tightening. The meeting touted gains as we expected, such as Q4 GDP growth going up to 3.46% from 2.54% in 2023, and improvements in non-oil sector, with the oil production also going up to 1.55 million barrels per day from 1.22 million barrels per day in earlier quarters. Governor Cardoso may want to get the bad news of high rates out of the way as soon as possible, at the risk of a hit to economic growth and the risk of sliding into a deeper stagflation. I like the slant on plugging leakages, tightening the rules against mischievous FX players, while also trying to relax the process for genuine merchants. The previous central bank governor, that was Emefiele, he insisted that interventions were needed to get the decent growth that we got and a brisk recovery after the COVID shock. But Cardoso saw the 10 trillion or so naira spent for interventions as a misadventure, which at best the CBN had little competence to manage, heightening the upside risk to inflation. But he didn't give specifics on the quality and performance of those debt assets. I think we need more details there. The governor also dodged giving his own estimate on the value of the naira. Central banks, of course, we know, do not target exchange rates, but his emphasis on restoring confidence is spot on. You may have or not have all the reserves that you need, but your markets, investors, and stakeholders have to believe that you have what it takes, you know what to do, and you're working in the best interest of your country, of Nigeria. Integrity to a narrow data-dependent way is one way to get confidence, and I also think transparency is very, very important. We're a bit surprised at that reveal that as much as $26 billion of what he described as illicit or opaque transactions went through Binance last year. We definitely want more clarity and details on that. The next meeting is only a month away, on the 25th and 26th of May. This is going to be a marathon, so economic observers will need to be patient in any conclusions. And even if we do get positive numbers in the short term, we'll probably need to wait to see what the medium term and the longer term trajectory is going to be like before we can really say if all this is going in the right direction. The president's desires for a low interest rate environment to attract real investment will also have to wait a bit. Markets are, of course, pleased that the Onosoye report is being implemented, which should significantly bring down cost of governance. The tone is definitely being reset as the public sector coat apparently is now being cut according to the cloth available. Well, that's it from us on Global Business Insights. If you enjoyed the program, please share and kindly follow on Facebook and LinkedIn. Subscribe on YouTube and X. Thank you very much for watching. This is Bode Oshosami. Bye-bye.